Yes, okay. We have Francesco Bianchi, who is going today to update us on the situation of institutional adoption of DeFi and in general how all the big companies and especially institutions are approaching DeFi world. Francesco encompasses very vast experience in the sector, and he is representing KBK, which is a leading treasury firm and Web3 space. So, Francesco, the stage is going to be yours, and we're very curious to hear what you will tell us.
Me, Francesco, as part of Spaghettif, we started. We supported from day one Napolif, then now is evolving to CityReal Shift, encompassing multiple digital aspects other than blockchain. So today we are basically going to deep dive into how the on-chain finance, or if you want to call it DeFi, is evolving to adjust to the evolving market conditions, aka to also incorporate AI into its own day-to-day activities. Where can I move slides? There, perfect. So first things first, I'm Francesco. I'm active in the space since 2020, so kind of an OG. First of all, I started my own DeFi journey into yield optimization. We are going also to touch base on this pretty soon. Then I moved to credit markets. There are kind of the new things on chain, and then actually moving to a non-chain asset manager, basically handling in a decentralized way your yield generation for everyone who wants to deep dive into blockchain stuff. So the main point about this presentation is that DeFi is kind of mimicking the TradFi world. So no. Okay, is mimicking the TradFi world. What does it mean? Is that it's following the same evolving a growing pattern than traditional finance, but at a 1000x speed. This slide, for example, the next one. Okay, the next one can basically show us what I'm saying. Here we have from 2000 before Christ. 2000 before Christ up to almost today, we can see the development of traditional finance from coinage to then credit and banking, derivatives, capital markets until today. And the DeFi is basically following the same pattern, although in a very super fast way. And this is probably one of the issues of our own business. So we start. Basically today I want to give you, and I'm glad that you are here, a quick overview of the history of DeFi and how it's basically facing the latest issues, adjustment that the traditional finance is pushing on the blockchain stuff. So we start from 2009 with Bitcoin, and you see that in parallel, it can be kind of parallel to almost 2000 to 500 before Christ period, where basically a new coin developed. In this case, we have Bitcoin. Bitcoin is de facto store of value on chain. It's kind of the new gold, the digital gold. And then later on in 2013, we know that Satoshi Nakamoto is behind all of it. And then in 2013, Vitalik, among plenty of other nerds in Berlin, also thought about Ethereum. What is the biggest difference with respect to Bitcoin is that Ethereum works on a chain that is programmable. And this means that we can program and create mechanism, automated mechanism that if this, then that, create automation with this, the financial world. And this is the real deal about smart contracts introduced by the Ethereum. Why so? Because the traditional finance has already its own rails, but can find enhancement, improvement, more efficiency throughout automatic smart contracts behavior, discussion, and so on. So in 2013, there was the first white paper from what we can now call Ethereum Foundation, and then in 2000, I missed it. In 2015, the Ethereum chain was deployed, and now is basically working as we know. So, as I was telling you already, the idea is that we have smart contracts, and smart contracts can create automation out of human and manual intervention to basically deal with multiple actions altogether. So, if you can think about Bitcoin as an high street, we can think about Ethereum with an high street with plenty of stops to basically stops by and create alternative and additional experiences. And we're basically going to follow on the Ethereum chain because we know that Bitcoin is still a bit lacking on additional use case. But instead, Ethereum chain created a lot of use case on top of its P2P distribution of tokens. First of all, we have the 2019 area that can be in parallel aligned with banking and credit. What does it mean is that we created, basically, we entered the P2P distribution lending. What does it mean? That if I need to send some money to this lady in the front row, I can do so through the blockchain. The point is that it was working only on a P2P approach. The first instances were MakerDAO. That is no more a case now because it basically changed to Sky. And then we have also EtherDelta, that is now the super famous Aave. In both cases, the idea was really rooted in DeFi ethos, so basically completely decentralization of the token and no intermediation at all of the distribution between players. I don't know if you saw that last night Claude was basically blocked by the American government because it was saying that we were distributing AI technology to foreigners. Well, this 2017 approach to blockchain token distribution was exactly at the opposite of this approach. Basically mean that everyone who can have proper use and fair use of blockchain can distribute tokens among peers. Well, this was at the first step. Then later on in 2019, so one year after, we understood that the P2P approach was a bit limited. So there was the need to instead pooling funds. So all users deposit funds in a pooled pools, and then depending on the smart contract rules, these funds were routed to different needs and different players. The clear example is Uniswap. Is de facto most probably the most used DeFi protocols nowadays. According to the stats, it has been forked around 300 times from the first time of deployment. So, okay, is something that is really kind of rooted in the DeFi roots. The concept here, instead of having, as I was saying before, so P2P approaches, so banking and kind of credit, so clientele approach. If I know you, I can give you funding. Instead, in this case, it was a kind of capital market. So everyone who wants to enter that pool and accept the entering price can basically deal with it. Nowadays, we know that UniV3 has Uniswap has developed multiple new instances, Unipass v2, Unipass v3, with different nuances. Within KBK, where I'm working, we are kind of still judging which one is the best one. Uniswap v2 seems to be the best one from our own perspective, but from a disintermediated perspective, instead, UniV3 seems to be the perfect one to let users basically interact with one another. Later on, we have the derivatives period. That probably is something that we are going to take a lot of time during this short presentation. What does it mean? Instead that we move up from simple if transfer, USDT transfer, from me to another person. We basically started wrapping these altcoins, so ETH or WrapBTC, to basically do some more sophisticated activities. In this particular case, we have two examples. One that is really ordeal, Synthetics, that was instead creating a stablecoin that was not only pegged to the USD value of the underlying token, but also to the activities on top of it. And then we have Securitize. We at KBK, we are working a lot with Securitize. Securitize, what it's doing, basically, is bringing on-chain the same ownership of a traditional finance equity. We are not there yet. Most probably we will need to wait for the Clarity Act to have the full 101 presence, but we are moving there. What does it mean is that if I own a securitized LP token, I have the same equity distribution of a traditional finance player. I don't have yet all the ownership rights of traditional finance players, but this most probably will come at a later stage. Anyway, so the derivatives period was a key one. We can see from, let's say, the parallelism from the initial period, you see. So we are basically in 19th century, to tell you how fast is evolving the DeFi ecosystem. And basically, what does it mean? Instead of just transferring token that has either a 101 pegged value or a variable value to BTC to ETH, we are instead distributing tokens that have a value that is related to traditional markets. What does it mean? Yesterday, there was the new Elon Musk SpaceX ICOs that was also distributed on chain, although there were plenty of blames against it because the on-chain distribution was a bit capped with respect to the traditional market. But players on chain basically had the opportunity to deal with a traditional finance ICO in the same way as the traditional players, although not being super sophisticated, certified players. And then we move to basically the last phase, the one of Eurodollars and retails. We know, unfortunately, that the DeFi ecospace is strongly US-based, but now we are seeing more and more other tokens, other fiat tokens evolving. What does it mean is that for the time being, if I want to offer you a US-based yield on-chain, I have multiple opportunities. But if I want instead to offer you a Euro-based one, well, it is a bit harder. It is a bit harder to do so completely on-chain. I need probably to deal with centralized exchanges to hedge my FX rate or other opportunities. So in this last phase, the Euro-dollarization and the retail approach, we have new opportunities. So in 2021, we have Ondo that basically started bringing on-chain money market funds. What does it mean? The money market funds are traditional funds. The point is that being almost as liquid as money, they are basically letting us respect the block by block exit requirements that the DeFi guys were having. What does it mean? It means that if I'm deploying my funds on Aave, I know that basically I can exit almost the block after. So if I deposit now, in 30 seconds I can exit. This is not something that is basically happening with traditional finance. Instead, we know that there are some delays. Well, these tokenizer protocols, Ondo Finance, Securitize, Centrifuge, basically understood that if they want to really enter the DeFi game, they need also to abide to the rules of DeFi. And the rules of DeFi are that we need to not trust, but verified. But on the other hand, also we need to be able to exit whenever we want and not wait until the middleman decide that we can exit. And on the market, basically did so at first in 2021 by bringing on-chain money market fund with either T0 or T1 exit period. Later on, we have, it's also important to mention Ethina, that boom, basically by bringing on-chain the carry trade, the basis trade, basically creating an arbitrage and a yield out of spot and future rates, in this respect, most probably to ETH. Although now it's also true that the basis trade is kind of lagging behind, so we have multiple, instead they are integrating multiple treasury bills to basically support the yield. But nonetheless, it was anyway a sort of innovation. Why so? Because they let us, users enjoy a carry trade solution fully automated on-chain without the need to be KYC'd, fully onboarded and this kind of stuff, but basically gain about volatility in the market. And last but not least, we have Pendle that was instead that basically introduced the kind of treasury split. We know that the DeFi yield works a lot on top of incentives, and on one hand, I'm a bit against it because the DeFi game basically kind of inflated the incentives games. Okay, we are new, so basically we had to incentivize up to 25% new players. But on the other side, it's part of the game, so everyone is incentivizing. We all see new banks basically welcoming you to open a new account by just saying, guys, you can have 1, 2 extra incentives on top of your banking account, so makes sense. But on the other side, I'm also glad to see that nowadays, unfortunately I'm missing a slide for it. Nowadays, we are having, I say, less and less interest on incentives. Why so? Because people understood that one thing is to have a base yield based on either USD or Euro in interest generation. Another thing instead, basically betting on the governance token of Ondo, Ethina, Pendle to basically be priced up until the moment I can sell it. And then I think that I'm done, yes, with slides, but we can continue the discussion. So what is happening nowadays? Nowadays, we are basically moving away by the poor concept of DeFi. So the decentralization concept is a bit, I would say, put aside from the incumbent players. Why so? Because the incumbent players are traditional players. Traditional players that basically are rooted into capitalism, and what they say, what they see that blockchain, sorry, okay, we're here. Blockchain basically let them use another rails that are way more efficient and way more automated with respect to traditional banking rails. And this is one probably of the key aspect of, the key thesis about blockchain, that blockchain is here to stay. It's here to stay because the banks, the investment banks, the hedge funds see a real deal in dealing with it because they see kind of better margins and better result. The point is that we shouldn't really lose all of our ethos at first in creating decentralized solution. Again, going back to the example that I was creating, that is probably really fitting the theme of the CTRL Shift conference, that we have a new digital world where blockchain commingle with AI automation. Well, the US government was able all of a sudden to stop the approach to the new Fable from Claude, while the idea of blockchain is that you have full ownership of your token and no one can basically block you from using it, spending it online. As I was saying, we're losing a bit of ethos about DeFi, but it's okay, it's part of the game. So this was the pros. What has this was the cons. What has instead the pros? The pros are we are dealing more and more with traditional players in particular dealing with Ondo or Securitize, are basically, no, it's not working, but it's okay, are basically seeing the blockchain as an additional distribution layer where they can find new funding. And this is what me, as a KPK contributor, are working. We just started some new markets, some new vaults with Securitize. These vaults are particularly of interest because they are kind of hybrid solution. What I mean is that in this hybrid solution, we have on one side the full pirate experience. So anyone with a wallet can deposit his USDC and earn a yield, no matter the background, the KYC, or whatever. On the other side, instead, we have borrowers that instead are fully compliant, fully KYC'd, and only them can deal with the borrow side. And I see that, I mean, on one side, I would say that I would love to see only permissionless approach to finance, but it's also true that we have some incumbent players that have plenty of money spent on compliance that don't want to ruin everything. And so basically, they are kind of happy with this hybrid approach where on one side, you can have fully DeFi ethos, but on the other side, instead, you have also compliance natures. The key point about compliance is that nowadays we don't need no more full compliance. What does it mean? It's that I don't need to upload my ID, my certificate of being an educated investor and so on, but I can just use ZK. ZK, aka zero knowledge, is the new technology brought up. We are done. Okay, we're done. 2 sentences. The concept is that blockchain nowadays can let us deal with compliance in a more decentralized way, so through ZK, and can also let us basically deal with token and yield generation on chain without being fully compliant and so on. And my point is that compliance is not a problem. The real problem is ownership of the data that we are sharing with traditional players that sooner or later are being leaked, hacked, and so on. And we don't want so. So basically, ZK proof can be a solution to let us deal in a compliance way with financial market without spreading all around our private data. Thanks. It was chaotic, but thanks to all of you that attended.